Look at that. IWM is up 1.25% today, following a mainly in line PCE report. And let me just be honest with you guys, I think the selling is probably close to done in markets. But don't be confused, because this is going to be a volatile market for the next couple of months. This is a day trader's dream. And I do expect there's going to be a lot of big up days and a lot of big down days over the next coming months, and I will share with you from my perspective what's coming next. But I do believe this 5% top to bottom mini correction was kind of just like what you seen in Q1 when markets fell about 6% top to bottom, and it was because of earnings coming in good, actually. But the earnings expectations pricing in something that was unrealistic. Now, yes, we do have earnings coming next week from Apple and Microsoft and many other large companies as well that will be important. And if they have outright bad earnings, that'll definitely negatively affect the markets. But as long as things come in okay, I think a lot of the selling is probably over with at this point. Axios says today another round of encouraging economic data showing that this time of high inflation may truly be behind us for real this time. Nick Timmerhouse writes on X, the core PCE index rose 0.18% in June, spot on with expectations, holding the 12-month rate at 2.6%. May was revised up to 0.13% from 0.08%, which is the most benign possible explanation for the larger than anticipated Q2 figure reported on Thursday. So Nick Timmerhouse is basically saying, this is great. Nick Timmerhouse, someone seen as the Fed's mouthpiece, saying this is a pretty good representation of what the Fed also thinks about this PCE report today. After all, if we were to run at this same pace, 0.18% over 12 months, you're going to be at 2.16% PCE in no time at all. Fundstrat on X says July seasonality argues for a strong end of the month rally. Prices bounced to right near the intraday lows from last Friday, 5,497, but did not exceed this level. And this remains a structurally significant area for price currently and into next week. Now, Tom Lee actually went on CNBC, I believe it was yesterday, to say he's not expecting much of anything to actually happen in the month of August for the S&P, but small caps can continue to do well, and he still believes a rally about 40% in 9 weeks. Now take a listen to what Mark Newton, also with Fundstrat, said on CNBC.
Now is Brent Schutte, the Chief Investment Officer with Northwestern Mutual Wealth Management. Also Mark Newton, Fundstrat Global's Head of Technical Analysis and Strategy. Brent and Mark, thank you both for being here right now. Brent, we'll start with you with regard to the CIO type view on the setup. Is this something where we should be worried as investors that there is even more downside ahead?
I do think there's more downside ahead because I do see the economy continuing to weaken despite today's GDP report. So if you think about the airlines, you think about the autos, and you think about the services side of the economy, which has held up the U.S. Economic growth, you are seeing some weakening there. I remind people the ISM PMI services has been below 50 or in contraction for 2 of the last 3 months. And historically, when that occurs, you are headed more towards a weak time period. And so I do think as interest rates remain elevated, as that debt reprices, you're seeing credit card and auto loan delinquencies increase. I do think that you are likely to see an economy that continues to weaken, as well as a stock market that has trouble pushing higher in the near future.
Mark, let's bring in the chart side of things. Is it more important, and I know on a short-term basis, things can change, but on the longer, medium-term basis, is it more important for us to see strong leadership out of those Mag 7 tech, media, and telecom stocks, or is it better long-term, medium-term, healthier to see a broadening out of the rally to small, mid-caps, and either other S&P 500 companies that are not in the top 7?
Yeah, hi, Dom. Look, I would argue actually both are very healthy. The large cap technology represent a majority of many of the indices. So it is, of course, great for the indices to see these stocks continuing to show excellent earnings and very good technical strength. However, with the recent drop in interest rates and some weakness in CPI, we have seen a real broadening out. It's helped small caps, it's helped mid caps. That certainly helps to add a lot of confidence to this rally at a time when many are concerned for a lot of the right reasons But we haven't really seen any evidence of really technical deterioration to suggest that we're going to see a larger pullback. I mean, it's been healthy to see that pullback in technology. Meanwhile, sectors like financials, very important part of the market, industrials, REITs have all started to climb back. And I think that's actually a very good sign.
Elaborate on that, Mark, for a moment for those who are concerned that we're seeing some defensive tone to the market today.
Well, we did see some defensive tone to the market in the last week, but technically, we did not see any real technical undercut of the uptrend lines that have been in place. I refer to this as a great rotation, and as Tom Lee has talked about, this is the summer of small cap. We've seen an amazing period of outperformance by small caps versus the S&P 500, and I think that bodes well for the next 4 to 6 weeks to see continued gains at a time when many people are starting to get more cautious. So really, the technicals haven't given us anything to be concerned about. Breadth levels are in great shape, good participation, but that minor pullback in technology, we didn't do any damage, but it pulled back exactly where it needed to, and now we're starting to turn higher. So look, we are entering a time going forward when it is going to be a lot choppier. So to the bear's credit, the time between September and November historically has been difficult for the bulls. Some of that was due to 2008, but in general, it should be a choppier period in the months to come ahead of the election. But I'm still bullish. I don't think we've seen anything that would really deter us from staying long in this market, specifically on the small cap side.
So if you guys have been investors watching this channel for a period of time, I am not afraid at all to call tops in markets, to say, hey, we're probably going to fall here soon. And that's exactly what I was doing at literally the recent top in the markets. Around the first couple of weeks in July, I was expecting some kind of correction of sorts. I said 7% was more of a base case, 10% was the more, typical correction that you typically get, and then 13% down is the average correction you normally get during an election year. And we've gotten 5% so far. Now, we'll talk about this a little bit later throughout this video. I do think a larger correction is in store before the election, but I think we don't have enough actual policies outlined from Kamala Harris, from assuming she's the Democratic nominee, from even Trump for that matter, around the tariffs, what countries would be affected or whatnot, to get utterly concerned or more concerned about that now. I think that's more of a topic of conversation around the debate, maybe in October, can't skip over October there. I think that's potentially when you get more of a 10+% correction based around election fears. Now, I do agree with Mark Newton. It's going to be choppy over the next couple of months. And that was actually the first time we watched that clip together. I had not watched that clip as well. So Mark Newton's on the same page as I am. But that first individual, guys, let me just tell you, again, I'm not afraid to be bearish or to be bullish for that matter when the facts change. But the markets right now, I would say, are far from pricing in any kind of weakening economy or growth scare out there. Why? Because small caps are outperforming. Small caps would be lagging the S&P. Small caps would be selling off if the markets were really looking at economic data and getting fearful. We're not even close to that yet. Small caps outperforming is the last thing that would happen in that kind of environment. Now, eventually that will happen. Yes, I think Wall Street is delulu or delusional, if you want to use a more technical term. I like delulu. I think it sounds a little bit better. Expecting a soft landing, okay? When you see rounds of inflation that spikes and stays high for a couple of years, that always leads to a recession, historically speaking. Now, there's not a lot of precedence on that over the last 50, 100 years, but every time that has happened, it has led to a recession because people start to run out of money. They start to, run out of savings, which has already happened. They start to default on things because prices are so unaffordable. Let me tell you right now, if I was in a situation where I had to choose between my credit card bills or, buying food for that little guy over there, I'm going to buy him food first, okay? And a lot of people that are just working jobs, normal 9 to 5 jobs, have not seen wages increase anywhere, like literally not even remotely close to the cost of living increases that we have seen. Specifically, when you look at things like food, just absolutely insane price increases we have seen. That will lead to a recession at some point. That will lead to a growth scare at some point. Now, does that happen before the election? Probably not. The government probably does not want to, show the economy looking bad before an election. That's typically not a strategy the government likes to employ. But I think potentially November, December, first quarter of 2025, you're going to get more of a growth scare. And that's going to lead to markets pulling back 20, 30+%, in my personal opinion. But from now until then, at best, I think we get a correction. And I do think in the near term, over the next couple of months before this election correction, call it between now and some point in September, so the rest of July and likely throughout the month of August, you're going to stay in a trading range between likely 530 and 550 on the S&P 500. Like a very close range. Let's chart it out. 550 to 530 is a 3.5% range. I think you're going to have, lots of big up days, lots of big down days for that matter. But I don't think you're breaking new all-time highs anytime soon. I don't think you're going to break, under 530, at least until that election correction comes. And I think it's just going to be a very volatile market for a period in time. Now, Tom Lee over with Fundstrat says PCE important for Friday. Small caps just generated a signal only seen 10 times since 1979 and almost always is early cycle of a signal with a 100% win ratio 3 months, 6 months, and 12 months later, 90% win ratio 1 month later. Since July 11th, June CPI, our stance is that June inflation gives the green light for small caps to advance. In our view, this was a durable signal, even as many suggest this is only, quote, a short squeeze. And this is 11 of 12 consecutive daily returns with a magnitude of 1% or more forward returns since 1979. So anytime you have seen this, you have been very positive over the next couple of months. Now, yes, to everyone else's credit, especially the Bears' credit, when you see small caps outperform the way in which you're seeing, it normally happens at bottoms of like market crashes, okay? That's not where we are now. So it's kind of unprecedented to see small caps that have went through this massive rally as general markets are pretty much at all-time highs. Now, you can make an argument that, the average stock in the markets is not at all-time highs. The average stock is still trading at huge lows. You can look at PayPal, hasn't done crap in years, trading at almost multi-year lows. So yes, there is the argument to be made that the bifurcation in the Mag 7 or Mag 6 for that matter, maybe you can include Tesla in that at this point, has really skewed this market. And maybe that would make sense, that maybe you start to get a broad kind of uptrend in markets, and the outperformance in small caps potentially started that. Tom Lee also shares this to his X account from RenMac Renaissance Macro Research and says housing is in a recession. And this post says expect a notable slowing in single family residential construction activity this summer. In June, new home sales, but not yet started, fell to a fresh cycle low of 74,000, declining 35% against last year. Series trends tend to lead housing starts by a couple of months. And this is the calendar for earnings coming next week. You have McDonald's on semi, Phillips Monday pre-market, Tilray, Symbotic, F5 latest Tuesday and after hours, Tuesday pre-market, SoFi, PayPal, Pfizer, BP, P&G, Tuesday and after hours, AMD, Microsoft, Starbucks, Arista, Pinterest, First Solar, Caesars, Lemonade, EA, and GeneX. Wednesday pre-market, Boeing, Norwegian Cruise Line, Kraft Heinz, Altria, Humana, Chemico, Generic, MasterCard, and Teva. Wednesday and after hours, Meta, ARM, Qualcomm, Carvana, Lam Research, Riot, Albemarle, and Paycom. Thursday pre-market, Moderna, Canadian Natural, Crocs, Mobileye, ConocoPhillips, Wayfair, SiriusXM, Canada Goose, and a couple of others. Thursday and after hours, that's really going to be your big day with Amazon, Apple, Intel, Coinbase, DraftKings, Roku, Block, Marathon, Booking Holdings, and Mercado Libre. And then Friday pre-market, ExxonMobil, Chevron, Sundial, Frontier Communications, and a couple of other names. So this will have a huge chunk of the S&P 500 earnings. And basically after this next week, you're not really going to get any other earnings that will move markets, right? I guess, obviously, NVIDIA will move markets probably the most coming over the next couple of weeks, but that's still a couple weeks down the line. But as I said previously in this video, as long as you get earnings that come in good from these mega cap names, which would be the expectation at this point following the other earnings that we have gotten, then I think the large selling is again probably done for a period in time. Could you still fall to about 530? Yes, that's the trading range I'm expecting. So yes, you could still have more downside, but I think it is unlikely that we go through any kind of larger correction than that. Again, at least until the election itself. Bar chart on X says small cap stocks IWM have finally broken through the 3.5-year trend line against the S&P 500. So this, on a technical basis, is a very good sign. Ryan Dietrich notes the first drop, 2% drop for the S&P 500 since February of 2023, one of the longest streaks ever. Be aware that the previous long streaks ended. The future returns were a tad better than normal returns. This by itself isn't a reason to expect the bull market to end. Autumn months have some of the highest frequencies of negative monthly returns. Since 1950, August and September have provided the two highest frequencies of negative total returns, with August being 41.9% and September being 50%. Fundstrat says of the 199 companies that have reported so far, 40% of the S&P 500, overall 69% are beating estimates, and those that beat are beating by a median of 6%. Of the 20% missing, those are missing by a median of 4%. On the top line, overall results are beating estimates by a median of 3% and missing by a median of 4%, and 52% of those reporting are beating estimates. So again, not great, but it could be a lot worse. Also see China going through a bit of a problem. China's consumer confidence at 86.4. That is an all-time record low. And as Mike Zaccardi says on X, he says year-to-date returns, QQQ up 12.4%, IWM up 10.2%, alligator jaws snapped quickly. Gunjan Benjiri on X, she is with the Wall Street Journal and contributor to CNBC, says overall a great week for U.S. economic data. GDP rose 2.8% in the second quarter, well above economists' expectations of a 2.1% rise. PCE data this morning shows spending is still healthy. Inflation continues to fall. Jason Gopher on X says decent track record for QQQ when RSI drops below the 34 area during long-term uptrends above the 200-day moving average. The only outright failure over the next 3 to 6 months was January of 2022 that initiated the bear market. Ben Hendrick says on X, the economy is strong, quote, durable goods, hold my beer. And yeah, it was just a straight drop. That's what we reported earlier with durable goods yesterday coming in at negative 6.6% month over month. This could be a sign that, you know, less lagging data for the month of June is showing the economy is rapidly weakening. And eventually, I think this will continue. And then it will start to get reflected in the data that, hey, maybe we do have a problem here. Maybe we do go into a recession. I think that growth scare will be coming, but I think it's far too premature for that at this point, given the GDP numbers just came in at 2.8%. And let's be honest, this market is controlled by algorithms. Algorithms don't give a rat's ass what caused GDP to be 2.8%. The fact that it was mainly inventories, government spending, and one-off instances, algorithms don't care. Markets don't care. The number came in at 2.8%. Don't fight that. Even if GDP gets revised down 50%, you're still going to come in at 1.4%, which was the same as Q1. So, I mean, you would have to see some pretty crazy downside revisions for GDP to come in lower than Q1. So I think for the next period in time, until durable goods gets worse, personal spending gets worse, defaults continue to rise, or retail sales get worse, or earnings come in bad, I don't think you're going to see a growth scare at least until the end of this year, maybe November or December. That's when the data could start to reflect what's actually going on in the economy. Just again, because everything is so lagged behind. But then again, there are a lot of people saying recession is incoming because the 10 and 2-year yield curve inversion is only inverted 14 basis points. Well, what's actually going on is, and what tends to happen if we actually pull this out to, let's say, 1950, is the yield curve uninverts. Yes, that tends to be painful for markets when that happens. That tends to coincide with recessions. In fact, it's not the inversion you need to be watching for, it's the uninversion. So people are correct. You're only inverted 14 basis points now. You're uninverting. But the reason you're uninverting is because the Fed is about to start cutting rates. Now, when do you normally go into recessions? When the Fed starts to cut rates. So I don't think this is as important as some people do because of why it's uninverting. The Fed's about to start cutting rates. That does not necessarily mean we're heading into a recession, at least in the immediate near term, although that's a possibility. It doesn't have to mean that. CNN's fear and greed indicator today is neutral at 47. The previous close we had was at 39. So the CNN fear and greed indicator has improved quite a bit today. Market momentum is neutral. Stock price strength is greed. Stock price breadth is neutral. Put and call options also neutral. Market volatility is fear. Safe haven demand is extreme fear. And junk bond demand is extreme greed. You do have the percent of stocks currently trading above their 50-day moving average up to 69.37%, which you're actually seeing a rise of over 5% today. So 5% of stocks are trading above their 50-day moving average today, in which they were not yesterday. And following today's PCE report, it really did not change much of anything for the expectation for Fed policy. It actually raised the odds of 3 cuts by December 18th from 54.1% odds yesterday to 56.7% odds today. It also, which is kind of interesting, lowered the odds of only 2 cuts from 36.9% yesterday to 33.4%. So this data today seems to really be validating Wall Street's perspective that the Fed is going to be cutting rates at least 3 times by December. As far as the AI investor sentiment survey that came out on July 24th, bullish investors dropped quite a bit to 43.2%, neutral investors dropped to 25.1%, and bearish investors dropped to 31.7% from 23 rose from 23.4% up to 31.7%. And reflected in that, 10-year Treasury yields are falling about 5.5 basis points today, down to 4.20%. And really everything today is doing quite well. The VIX is getting smashed down over 8%. The Russell 2000 is up 1.18%. The NASDAQ is up 1.06%. The S&P is up 1.2%. And the Dow is up 1.67%. Again, if you were seeing fears about the economy, the Dow would also be underperforming relative to the NASDAQ and likely even the S&P, given the market weighting in the Super 6 or Mag 7. But you're not saying that. Russell continues to do well. The Dow continues to do well. And at this point, Wall Street is not, there's no focus at all about the economy weakening. And I do think that presents an opportunity, because I do think there will be a much better buying opportunity by the end of this year, likely November or December, if not Q1 of 2025. That's when you're really going to start to get those growth fears, growth scares coming into markets. That's potentially when we could actually even enter a recession. That's when a lot of Wall Street will start to bring up the recession conversation a lot more. And I think between now, really throughout the month of August, you're going to be between 530 and 550 on the S&P. That's just it. I don't think we're hitting new all-time highs. I don't think we're going to be plummeting as well. I think it's going to be a choppy up and down market over the next 5 weeks. Now, September could open the door to an election correction when we get more details about policy of, Trump and potential Kamala Harris presidencies. But until then, I think you got 5 weeks to kill. And this is going to be a fantastic trading market. Maybe not as much so if you're invested in the S&P on a headline basis. And I do think right now cash is king. I think you want to raise as much cash as possible, waiting for those growth fears, those recession fears to actually come into markets. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. Nonetheless, you guys have a fantastic rest of your day, and I will see you in the next one.